Welcome back, everybody. Bruce Sellery joins us today with 4 overlooked tax deductions and credits that could
be
excited. Huge for big score return. Let's begin with this. Credits versus deductions. What's the difference, Bruce?
Well, it's not really an important definition, but it is an interesting definition. So a deduction reduces the amount of income you have. Like an RSP, you are able to reduce your amount of income, and the credit actually reduces the tax owing. So the net effect is you pay less tax, but in 2 very different ways.
Very different ways.
Here's the first one I want to talk about. Medical expenses. Okay. So there are a lot of things on the list that you don't necessarily think of. Things like services like dental, maybe even tutoring. So if you have a child who's dealing with a learning disability, and it's expensive to get that kind of support. So that could be on the list. Those are services. There are also products. So things like prescription drugs that aren't covered and equipment for relief or treatment of an illness. So there are lots of things on that list.
But what if you have a company plan that covers the prescription drugs?
Then you're good.
Whatever's remaining,
Correct.
You can still?
Correct.
Really?
Yes. Now here's another surprising one: gluten-free products.
Okay.
So for people who are gluten intolerant or celiac, those products may qualify. Now that'd be a hard thing to keep track of, like the bread every week, keeping the receipt handy for that. But that's an amount that's relevant. The other thing to notice is that, remember the fitness and arts credits for kids? They're phasing that out. So you've got 1 more year, but it's 50% of what it used to be. But still hold on to those receipts for this year.
And we also have the lines 330 and 331.
Yes.
Okay. Up next, charitable contributions. You have an interesting tip there.
Well, this is a big one. So you get more of a benefit, more of a credit, the more you contribute. So you want to exceed $200, and the way to exceed $200 if you don't contribute that amount is combine it with your spouse or wait for more than 1 year. So you've got a 5-year carry forward that you can use on that front. So really the biggest challenge on charitable donations is keeping track of the receipt. If often they email them to you, do a search on your computer for tax receipt and see what comes up. I tend to print them off every single time.
And that's line 349.
Yeah.
Moving expenses.
Moving expenses and union dues. So union dues if you're a part of a professional association. Moving expenses, the really surprising one for me here is real estate commissions, which in Toronto is a big number.
Sure.
So you want to have receipts for real estate commissions, transportation and storage, utilities and disconnections, and also travel expenses in hotels and meals. Now the other thing to remember here is you have to be moving at least 40 kilometers to be closer to work. So that's the government's rationale. What they want to do is encourage labor mobility. If you're moving from one side of the city to another because you want to buy a prettier house, that's not what this is for.
So the whole thing is they want you to be able to work closer to where you live, and it reduces congestion on the roads, and that's why you get the benefit.
Yeah, and take a job somewhere that isn't right around the corner because that's better for the economy.
Ah, got it. Okay, the disability tax credit, lines 316 and 318.
The thing to know on this is that it's retroactive for up to 10 years. So the designation needs to be signed by a healthcare professional. Okay. There's a lot of things, but here's a surprising example for some people. For me, it was child with type 1 diabetes. So that is a really tough diagnosis. So there's lots to deal with and lots of costs. So you can qualify for that. Parkinson's, also clinical depression. So we're talking so much more about mental health these days, which is fantastic. It may be something that's relevant on your tax return.
Okay, last but not least, the eligible dependent credit, line 305.
Mouthful, a big mouthful, but this is really a benefit to single parents. So there's a couple of criteria. You did not have a spouse or common law partner, you supported a dependent, and you lived with that dependent. It could be worth about 11 grand on your tax return. So it's really worth thinking about. I have to tell you a secret.
Tell me.
I hate taxes.
Don't we all? Do you know anybody who loves it except for the tax
worst? You know, like every time this year, I have to come in on breakfast television and do like a segment on taxes, and I do it because you bring me donuts, but I hate this stuff. Like, I really just think it's the worst. But it's worth it because the financial benefit is so significant.
If not, you're just letting go of that money. That's yours.
So you got to do it. They're telling us to wrap up. I need a drink, by the way.
And
we
a
both
donut
need to
for
do
Abby,
shots.
by the way. I know that's your favorite. Can you please?
I'm totally taking that home for Abby.
You get a reward. Thanks, Bruce.
My pleasure.
BreakfastTelevision.ca for all this information. Over to you, Kev.